Hello everyone, my name is Chris Vecchio, currency analyst with Daily FX in New York. Just wanted to provide a quick summary video for those that couldn't make the Daily FX Plus webinar. We see here that the euro dollar is gaining after the inflation report this morning, 1% year over year in the month of February. That's the advanced print. That's from 0.8% expected and prior. The year over year, assuming that was the core print, the year over year headline, 0.8 versus 0.7 expected and prior. Also some resolution with Ukraine tensions. We see that the Ukraine currency is rebounding on the day. And pretty significant volume. So the euro dollar is actually benefiting twofold. One, from a release of regional tensions, and two, from its own data. We see here that range from yesterday, that 136.80, 137.70 that we've held for the past several days, over 2 weeks now. We got a nice hammer at that level. We never got the daily close below 136.80, and now we rocketed right back. So yesterday that could have been the tell that we were due for a reversal, right? We get a false breakout out of a range, return to the range, we move right through the other side. We've seen that happen so many times, and it continues to happen. So now euro dollar is back above that ascending trend line from the November 13 lows, and the tone is shifting more bullish once more after what it looked like it could be a bearish breakdown. We go over to, say, pound dollar. Pound dollar, we go on to like a 4-hour chart. You can see here that price is still struggling to get to this 167, 167.35 area. We've been treating it as a swing level since the 17th, 18th, and thus far there's been very little upside. Again, pound looks like it's getting a boost riding the coattails of that Eurozone data this morning, as well as that Ukraine news. Going over to Aussie dollar. Aussie dollar looked like it was working on that potential inverse head and shoulders pattern at the low, and that still remains a possibility. However, prices started to crack through this seemingly important trend line, rising parallel support here, going back to the December 18th lows. If we get a break above 90.85, that's when we're long. Otherwise, this is a choppy market. It's been a choppy market for the past, really, the entire month of February. I'm not interested until we get below 89 or unless we get above 90.85. I'm not a range trader. Finally, heading over to dollar yen. Dollar yen has started to break down. I'm going to draw this fresh here. We see after we got the breakdown from the late January swing lows, we formed a bit of a triangle now. And however you want to slice it, this triangle is broken to the downside. So the pressure in dollar is starting to build again. Earlier this week, we said the U.S. dollar was staring into the abyss. That kind of ticked the low in the dollar for a little while, but now the dollar is lower against every other currency but for the Aussie at that time. In terms of U.S. economic data due today, there is U.S. GDP out at 13:30 GMT. It's 8:30 Eastern, 2.5% expected from 3.2%. So we're going to have to see a beat there in order to dollar to get itself back off the floor. Otherwise, looking weaker now that the whole safe haven demand is waning on Ukraine. Of course, that could come back any time, but as it stands right now, it looks like it's abating. Euro is benefiting, pound is benefiting on the coattails, Aussie stuck in the mud, dollar yen trending lower. If U.S. equities rebound, generally speaking, if equities around the world rebound, maybe the yen comes off a little bit. Other than that, we're looking at a situation where the dollar is weaker after Yellen and the euro is avoiding any further downside thanks to those inflation data. We'll be back later on with an update, some more trades that we're actually looking at. And that's it for me this morning. I'll be back on Tuesday at 6 Eastern, 11 GMT in Daily FX Plus for a weekly trading Q&A. Would love to see you there. If I don't speak to you the rest of the day, good luck trading and have a great weekend.